Hi, and welcome to Chapter 11. In this chapter, we're going to talk about the basics of investments. We're going to talk about how to set goals, when you're ready to invest, the best time to invest, how to look at the risks for investments, how to allocate your assets, what it means when you say beat the market. We also want to talk about identifying the difference between the primary and secondary market, looking at trade securities, um, using different brokers, and how to locate sources of information for investing. Okay, so when investing, the idea here is to protect your money and grow your money. You want to protect your money from inflation, and you want to protect your money from other risks, and you want your money to make more money. So it's important to understand investing from what they say a common sense perspective, which that basically means is being able to separate investing from gambling. So when you invest in, very short term or frequent trading or buying stocks to sell quickly to make some extra money or quick money, that's really gambling. Buying good companies and investing them for a long term and reaping capital gains and dividends for goals like retirement, that's more common sense investing. So you want to use your investments to reach your financial goals. So first, you want to understand what are your financial goals. Maybe one of them is retirement. Then you have a better idea what investments can get you to that goal. And you just got to figure out what your inputs are, how much you can save, and then what you can expect to return. And you want to avoid, excuse me, obvious pitfalls. And one of the biggest pitfalls are people who invest on emotion, invest on speculation, and really don't understand fully what they're doing and could put themselves at risk of losing a lot of money. Now, before you invest, like I was saying, you need to decide what your goals are. What are you trying to do? Are you saving for a house, saving for retirement, um, or and this will better prepare you for what investments you should buy. Um, you want to know how much money that you plan to invest, and you need to be, if you do investing, you generally want to do it on a routine basis, and you have to get a sense of what's the difference between investing and speculating, because you could do both with stocks and bonds. Typically, I see investing as buying assets for long-term appreciation, 10 years or longer. Speculating is buying and selling stocks within a day time frame or a month time frame or 6 month time frame to try to make some quick money. That would be speculating. And the problem with speculating is that most people can't do it for a long period of time and be successful. Some people can speculate for a few months or a couple of years and make some money, but it only takes one bad trading day or one bad trading week to lose all that money they worked so hard to earn in 2 years. Because speculations definitely mean you're putting yourself at a higher risk in some of your investments. Now, an investment is going to be an asset that's going to generate a return, either through capital gains, which is the price of the asset going up, or stock price going from $10 to $15, and dividends, stocks or bonds paying dividends. So the income return is usually the dividends or interest payments, depending whether it's a bond, it would be more of an interest payment, and if it's a stock, it's more of a dividend. Now, speculation is when you're basically buying a stock, hoping for a big change in the price quickly to make some fast money. Now, there are also, besides bonds and stocks, there are also derivative securities that you can trade. But the only one that you really can trade as a small investor is options. And this is giving you the right to buy or sell an asset at a certain price. And options are relatively tricky, not something a new investor would really work with. But they can be used to hedge your portfolio or to increase speculation and reduce risk. Okay, let's move on to the next slide. Okay, let's talk about setting goals, investment goals. So your overall investment is to increase your capital. So, but for what reason? I think the biggest investment goals for most people is to save for retirement. So you could write that down as a goal. That'd be your first priority. Your second priority might be to um, grow enough money within a 10-year period to buy the house of your dreams. You just have to figure out what these goals are and put them in order of how important them are to you. And then periodically, you want to reevaluate and reassess. Have you made the goal? Is it something that you're going to keep working towards? And and you have to figure out, you know, when when do you want this goal to be realized? In 10 years, 40 years, depending on the situation. So you could classify these goals as short term, which is within a year, intermediate, which is 1 to 10 years, or long term, which is over 10 years. So buying a house might be an intermediate goal term, and saving for retirement would be a longer term. Now the goals should be realistic, meaning that um, whatever you set out to do should be achievable. And you having a plan or a budget is a way to make some financial sacrifices so you could save enough money um, to really get a big return on the investment. So, how much money do you need? Typically, if you want to see decent returns in the stock market, you don't want to start with anything less than $10,000, and ideally, you'd want to have at least $100,000 invested in the stock market to start getting some decent returns. Now, Um, with dollar cost averaging, you can invest a small amount of money in the stock market every week, maybe $500 or $2,000 a month, which becomes $24,000 a year. When you can see how quickly you can easily get to $100,000. Sort of like a snowball. Once the snowball is big enough, it starts to pick up a lot of extra um, mass as you're rolling it along, as the surface area is bigger than a snowball, and it's just a lot easier to accumulate to a larger size. Now, what we call a financial reality check. You have to really have a good idea of what your financial requirements are as far as rent, utilities, other bills. You want to make sure that you're making enough money to pay all these things. You're living underneath your means, so you have money that you can save. If you're spending, if you're what they call living week paycheck to paycheck, week to week, you're living at your means. And that's, you're never going to be able to really save enough to do anything. So you want to redesign your life in a way that you have adequate money to save. And my goal for most people is to save 50% of your income after tax. So a lot of people say that's impossible. And I say to them, well, you're when you were in college, how much money were you making? Nothing. And how are you living? And how are you doing that? Oh, I was living at home and I didn't have a car. And okay, so it is possible to live without, spending a lot of money. So when you first start working, maybe you try to live a lifestyle, stay at home for a little bit longer to save some money. Um, don't jump in buying expensive things right away. Uh, don't take expensive vacations right away. So you can live below your means and save a good deal of money. Once you have a significant money saved, then the investments will start to generate money of themselves, and then you'll usually quickly come to a point where you can start having it both ways, having adequate investments growing continuously and having enough money to buy the nice things that you want. But two things that you should really make sure is that you have adequate insurance, especially health insurance, um, because unexpected health bills can really drain your bank account, and keep I would say at least 6 months of emergency funds um, before you're ready to invest, because you don't want to put a lot of money into an investment, have an emergency, then have to sell that investment at a loss to keep yourself afloat. So you always want a good starting point for investing in the market is after you've saved about 6 months of emergency funds in the savings account, then you could start saving money in a weekly or monthly basis to put into some investments. Now, you definitely want to pay yourself first. So what you should do is, if you say your company has direct deposit. Well, actually, the first thing you should do is, if you're working for a company, join the 401k and put the maximum money that you can put away into the 401k. And that might just be enough to start with. And that the great thing about that is that companies usually give you a match on that money, and the money will go in without having to pay tax on it initially. So it'll grow very fast. Once you take advantage of your 401k, you fund that to the max, then you can start funding a private brokerage account outside of the 401k. But this private brokerage account you'll have to pay tax on anytime you make money on your investments, as far as um, when you buy them and sell them and you realize a profit. Or if you get paid dividends or interest, generally you have to pay tax on that. So that's why I always say utilize your 401k first. And by paying yourself first, it means that the money is withdrawn from your paycheck before you even get your paycheck. So you just have to live on what the balance of your paycheck is, because you have your investments immediately withdrawn and invested. Okay. And that's why when it says here, take advantage of Uncle Sam and your employer, that means join the 401k and get that employee match. Um, if you have a situation, now you could also, if you're able to, in certain income brackets, you're able to utilize an IRA as well. So that's the best way to really start saving and growing your investment, is to be invested in these tax deferred accounts like an IRA or a 401k, because if you earn $100, state and federal local taxes are going to take probably $40 of that. So you only have $60 to invest. If you invest $100 in a 401k or an IRA, a regular IRA, the full $100 goes in, there's no tax on it, and then you're able to invest that. If you have some sort of windfall, you win the lottery, you somehow get some money in an inheritance, that's a good way to start investing. And then the book talks about this 2 month a year investment months, and this is basically if you can pick 2 months a year where you're really going to cut back on your spending. So maybe it's like January, February, where it's winter and you're not really doing much, you're not going anywhere. These could be good months to cut back on eating out at restaurants, on spending money on clothes or entertainment, and just really trying to save as much as you can in those 2 months. Okay. Now, fitting taxes into investments. So keep in mind that investment returns, if they're not in a 401k or an IRA, that you're going to have to pay tax on your investment returns. And this is only when you buy and sell something or get a dividend or interest. If you buy a stock at $10 and it goes to $100, you don't owe any tax. Maybe the stock goes to $1,000, you still don't owe any tax. If the stock goes to $1,000 and you decide to sell it, now you owe tax, because once you sell a stock, you realize the gains and you'll have to pay tax on that. And you'll pay them at the marginal rate, which we learned from a previous chapter, is that's the highest tax rate you're in, the last tax rate your income touched. So any investing money goes on top of that. So you're paying the most amount of taxes on your investments. Um, Now, if long-term capital gains get taxed at a much lower rate than short-term capital gains, so that's why it's advantageous to hold your investments for more than a year. Now, of course, tax-free investments, whether you're a deferred tax account like the 401k or an IRA, or it's a municipal bond that doesn't pay any taxes, state or federal. Um, so these are ways to lower your tax bill. So with capital gains is when the difference between buy a stock at 10, sell a stock at $25. The $15 gain is capital gains. You have to pay tax on that when you sell it. Any dividends the stock might generate, you have to pay tax on that. Any interest a bond may generate, you have to pay tax on that. So this is why you have to, you might be, some traders are surprised to see that they might trade a lot during the year and make $10,000 in their stock trades. At the end of the year, they could owe $4,000 on that money in taxes. So kind of a bummer. So that's why you always want to think of your tax situation when you're making your investments. Um, Now, when we talk about what they say, lending investments, these are when you have bonds or a savings account. You're lending your money to somebody, a corporation or a bank or a government, and they're going to pay you interest on that money. Those are called lending investments. Generally, typically less risky. Ownership investments are when you buy stock in a company, in a corporation, and you're going to be participating as an owner in that stock. So if they pay the owners dividends, you receive dividends. If the stock appreciates in value because it's considered more valuable, you get um, a return in the form of a higher stock price. Okay. Now, um, when you're talking about lending investments, a couple of things that you need to be familiar with. One is maturity date. So a bond, when you invest in a bond, there's a date at which the bond matures. So it could be a 10-year savings bond, and then it matures, and you get your money back. Or it could be a 30-year bond, or a 10-year bond, or a 2-year treasury. So there are these maturity dates, but you can buy and sell the bond um, any time in between the maturity dates as well. So you don't have to wait for these instruments to mature to sell them. You just sell them to somebody else. Now, with a lending investment, a par value is really the principal value of the bond or the um, treasury. So typically, a par value might be $1,000 for an individual bond. When they say a coupon interest rate, they're talking about the percentage that the bond is going to pay in interest. So if the bond pays a 5% coupon rate, that's really the interest you're going to earn for the year as an annual rate. And then you want to also have a better idea of what type of return you're going to get in this investment um, in the time period that you expect to hold it. Now, bonds can be riskier because if the issuer is a corporation and they go bankrupt, you can lose your entire investment. So there are some risks. The safer bonds would be the U.S. Treasury bonds. Those, because we assume the U.S. government won't default with a high amount of confidence, will not default on their bonds. We don't see much of a risk in the overall entire investment. When you invest in individual corporate bonds, there's a risk of bankruptcy and not being paid on those bonds. Now, if we go to ownership investments, one ownership investment I didn't mention before, but is mentioned here, is real estate. So this is when you buy real estate as an asset, you own the home, but you can also own an apartment building. And these rental units will throw off income in addition to the real estate becoming more valuable in the future. So investing in real estate and property generally, given a long time frame, most real estate investments always go up in value. And if the real estate investment is generating income at the same time, it's a good little ownership investment. Now you also have stocks, which is a little bit more easier because real estate's tangible. So if you buy real estate, you maintain it, you pay taxes on it, deal with other people if you're renting to other people. So there's a lot of other hassles and stress when you're owning real estate. Although I would say real estate is a lower risk investment because typically the value of the land in the house goes up almost continually over time, where stocks can be a lot more riskier because of individual corporate risks. But when you buy a share of stock, you own a percentage of ownership, a small percentage. And that percentage of ownership is how you get rewarded when the company does well. Either the stock price goes up or they pay a dividend to their shareholders. So the returns you get from investing is either capital gain or capital loss. This is the difference between what you buy and sell the stock at. If you buy the stock at 10, you sell it at 30, you have a $20 per share capital gain. If you buy the stock at 10 and you sell it at $4, you have a $6 per share capital loss. Now, any income that a stock may generate is going to be a payment that the company is going to pay you that you're invested in. These are considered dividends. So calculating the rate of return is pretty simple. The ending value of an investment, so if say it's a $30 stock, you sold the stock at $30. The beginning value, you bought it at $9. So that leaves you 30 minus 9 is, well, let's say, yeah, 30 minus 9 is 21. Then you have income. So maybe you had a dollar dividend. So that $21 now becomes $22. You divide that over the initial investment of $11 and you'll get your percentage return. And then if you want to do the annualized rate of return, you have to divide it by multiply it by 1 divided by n, where n would be the number of years. Now, if you look at the risk return trade-off, typically things that are riskier have higher potential return. So if things are riskier, the price of the asset should be lower to realize that risk. So the more risk you assume as an investor, generally the more reward you should reap, but the greater possibility of losing your money. This is why it's better to group a number of assets together, because one or two of them may fail, but three or four of them may do very, very well, making up for any losses on the couple of failures. So your goal really here is to eliminate risk without affecting your return too much. So the amount of risk and the amount of return, there needs to be a balance between the two. So you want to be compensated for your risk and the return. So you don't want to buy risky investments with a low probability of return, and you don't want to buy um, low risk investments with no return. What you want is hopefully a low risk investment with a high return. Those are hard to find. But if we were to plot these, say we're going to plot these on a scale, here is the risk of the variable returns. So as we go up this scale, the riskier it gets, and here's the annual return percentage. So treasuries are pretty safe, a low amount of risk, a low amount of return. This is just gauging inflation. Now, long-term government bonds are more return, and a little bit more risk. What is the risk? It's not from default, it's from interest rate changes. So if interest rates change, that affects the value of the asset. So long-term corporate bonds are have a little bit better return than government treasuries. And then common stock will have the most amount of risk, but also the most amount of return. Okay. So what is a nominal rate of return? This we talked about a little bit in the previous chapter with the credit cards. It's, the rate of return is a rate that you're going to earn on the investment without any adjustment for inflation. Now, the real rate of return would be, it's the nominal rate of return when you take out inflation. So basically, if inflation is 5% and your return on your investment is 5%, your real rate of return is 0. Because the money devalued by 5%, even though you got a 5% return, it was all eaten up by inflation. So there is, looking at historical levels of risk and return, investments with higher levels of risk should be producing higher levels of return. And for many investments, that's true. But in some cases, these risks can become greater if the economy goes into a recession. And that's when you see a recession, you'll see a lot of people selling in the riskier assets, moving into less riskier assets, because riskier assets tend to lose more money in a recession than less risky assets. So let's talk about some of these risks. The interest rate risk and inflation risk are easier to talk about these days because we've gone through a period of higher inflation and higher interest rate risk. For the last 20 years or so, inflation was very low. Even the last 30 years, inflation has been pretty low. And the interest rates have also been pretty low. But now that interest rates are making significant changes and moves, we see that there's a risk. So the risk with interest rates going up, the risk is that the consumer, seeing that auto loans are higher and home loans, mortgages are higher interest rates, and credit cards have higher interest rates, they may pull back on their spending. And this can create a recession, and this could hurt stock valuations. Also, when interest rates go up, you have bond values going down, so your bonds will lose money. Now, with inflation, it's very closely tied to interest rate risk. So if inflation goes up, you have, of course, your money's becoming less valuable, and that is going to make bonds be less valuable as higher inflation usually leads to higher interest rates, and it also spooks the stock market because higher inflation is generally creates uh, a devaluation of money, so people could buy less with the money that they have as prices go up, and it can lead to a recession as well as interest rates are increased to fight the inflation. Now, business risk and financial risk, they sound similar, but they're actually two different things. Business risk is the risk that the business can fail. So business risk is more about um, the type of goods and products being sold and services, how good the management is in the company. So it's really the risk of running the business. What if there's competition? What if the product becomes obsolete? So this is just really business um, problems with the change of the business. A financial risk is really just the ability of the company um, change in the ability of the company to pay back its debts. So when we talk about financial risk, we're really talking about the risk of a company not being able to pay its obligations and going bankrupt. Now we also have liquidity risk. So this is going to be the inability to liquidate a security quickly at a good market price. So some assets have more liquidity risk, like a real estate. It's harder and takes longer to sell real estate than it does a stock. So a stock could be sold, as soon as the stock market is open the next day or that same day, but it may take a house 3 to 6 months to be sold. So the liquidity of your investment is a risk. The less liquid it is, you may not be able to turn it into the cash you need when you need it. Okay, so market risk. This is the risk that the overall stock market will change in direction. So stock markets usually move where you have a bull market or a bear market. So the market risk is when the market turns into more of a bull market. So even though your stock is good and their fundamentals are good, the bear market is, think of like that bear and bull market like a tide. When the bull market is like a rising tide and helps lift all stocks higher. And a bear market's like a receding tide where the tide is going out and stocks are just going lower. And this is a risk that you have when you invest in the market, that if it just happens to be the time when it's a bear market and stock prices are going down, you're going to suffer more than you should because of this market risk that you can't really control for. There's also political and a regulatory risk. This is the risk of governments creating new laws that can make either your companies less profitable or more profitable. So say, for example, if legislation is approved legalizing marijuana around the world, and that's going to be helpful for companies that sell marijuana. If it's a gambling company and gambling becomes legalized in new states or new areas, that's going to help companies that sell slot machines, companies that run casinos. So just how the political or regulatory system changes can affect, some stocks win, some stocks lose. There's also an exchange rate risk. When now the exchange rate risk is, this is dealing mostly for companies that have sales overseas, or if you have an investment in a foreign currency. If the exchange rate changes between the two countries, you could lose money. So, for example, you might invest in a Canadian company. The Canadian company goes up 10% in value, but the Canadian currency goes down 10% in value, or maybe the Canadian currency goes down 20% in value. So now your profitable stock that went up 10% is losing money if you try to exchange it back into dollars. Um, Another risk, which is specifically to bonds, is a call risk. So this is a risk that someone might call the bond in early. Now, how this works is, think about refinancing a mortgage. If you got a mortgage at 8% and then mortgage rates went down and you go to refinance it at 4%, you're saving money on your monthly mortgage. But who's losing that money? The bank is. So same thing can happen if you own a bond. If you own a bond, some corporate bonds, and the company decides to refinance those bonds, they're going to give you your money back early. So they'll say, okay, here's your $1,000 you invested us at 8% dividend. We're giving this back to you because we're going to refinance our corporate bond at 3%. So that's a risk that you thought you would have a bond that would pay a decent amount of money for a long period of time, and it was called early. Now, one way to lessen your risks is diversification. So this is where you put your investments in many different assets. So instead of buying one or two stocks, you buy 20 different stocks, or maybe you buy a mutual fund, or maybe you buy stocks, real estate, and bonds. So this way, if there's an overall change in the market, um, not all the stocks or asset classes um, will have a bad return. Some of them may actually have good returns, and hopefully they will. The years where stocks go down, maybe bonds will going up, and it helps them mitigate some of the losses from the stock, or overall reduce your risk. And you can see that owning 20 companies, you have less risk of bankruptcy. So if you own just one company and that one company goes bankrupt, you've lost everything. If you own 20 companies, you definitely have a much better chance of avoiding a majority of your wealth being affected by bankruptcy. So 1 out of 19 stocks going bankrupt is going to have much less of effect on your investments than if it's 1 out of 1 stocks that you own. Now, there's two types of risk: the systematic and unsystematic. And this is important to know. So systematic risk is a risk that can be eliminated through diversification. So this means buying 20 different companies, and you're able to diversify your risk because you are buying all these different companies, and you're spreading your risk out among many different industries, many different stocks. So that you're diversifying, so that if something bad happens to one of the stock, you still have 19 other stocks or 25 other stocks that are doing well. Now, the unsystematic risk, these are risks that you can't really diversify away from. Things like interest rates, um, uh, market risk, these are things that are, non-diversifiable. But for the systematic risks, if you just go back here, um, business risk, financial risk, um, these are things that call risk, these are things that are systematic, you can diversify away from. But unsystematic, like inflation or interest rates, you can't diversify away from. So you can think of risk in those two different pools. So in this classic chart here, we could see this line here is total risk, all your risk in your investment. So if you only have one stock, you have the maximum risk. By buying more stocks, you reduce this unsystematic or diversifiable risk. Sometimes you can call unsystematic what we call diversifiable risk. So as you buy more stocks, heading towards about 25 stocks, you diversify away most of this unsystematic risk. But the systematic risk, the risk of the stock market going down, or the risk of interest rates and inflation going up, you can't diversify away from. So you'll see that this risk doesn't go down with the more stocks you buy, because this risk stays constant. That's why you see this horizontal line here, this risk here. This white area is the systematic risk. It doesn't get reduced when you buy more shares. I mean, more number of different companies in your stock portfolio. Um, so what is your tolerance for risk? Well, generally, if you have an investment and it's keeping you up at night, or you're worried about your investment at night, you don't have the tolerance for that investment. You should sell even at a loss. You could take this test here to see what your risk tolerance is. And it's your ability to tolerate the risk of your investment. Some people are much more capable of seeing long term and tolerating some bumpy ups and downs initially, and some people have less of a tolerance for it. So if you're somebody who gets really upset over stock prices going down, or temporary losses in the stock market, your risk levels, you may want to take less risky investments. Now, the longer you hold an asset, um, the more risk you can afford. So if you bought Amazon stock in the 90s when it was $20 a share, when you had this long horizon, knowing that you didn't have to sell it anytime soon, but you believed in the company was going to do well over a long time period, then that very risky asset becomes less risky through time as the company continues to grow and do better. So if you have a long investment horizon, you can take a little bit more risky stance in some companies. But if you have a very short time horizon, you may not want to be invested in stocks at all. But having an asset allocation, investing in different groups, different asset classes can help mitigate some of this risk, and that way you can assign some of your portfolio to riskier assets and more of your portfolio to less risky assets. So typically we should all be long-term investors, because there's definitely going to be good years and bad years in the market. And if you're invested long term, there's always many more good years than there are bad years. Bad years. So for every in a 20-year period, there might be 16 good years where the stock market's up, 4 years where the stock market's down. And you just have to, in those years that the stock market is down, you have to resist the temptation to sell and maybe even buy more in those years. But in the long term, if you just wait it out, you're going to make a profit. Same thing with most houses. If you buy a house in the short term, the first 2 to 5 years, you may lose some money in the value of the house. But if you hold the house for typically at least 10 years, 90% of those homes are going to be in a profitable position. So that's how you have to look at when you make investments or you buy something. You have to have a more longer term aspect for it. Don't expect to make money in 3 months, in 3 days. Um, Now, when you invest in bonds as opposed to stocks, you are getting dividends or interest on these bonds that help mitigate some of the risks. But certainly, if you hold the bond to maturity, you're going to get the full principal back. So you might put $1,000 in the bond in day one. That bond could go down to 700, 600, 500, 900, 1100, 1200, 400, and then as soon as it matures, they have to give you the full $1,000 back. So if you hold that bond the full term, you're always going to get the initial amount of money you invested in that bond, even though the price may vary greatly during the life of that bond. So here, if we look at here is common stocks, blue is common stocks in a 1 year period. Right here in this particular section, the common stock section, we have a 1 year, green is 5 year. This pale color is 20 years. So if we look at, each bar is going to show the range, the compound range of annual returns in the asset over a 50-year period. So for common stocks, if you have the common stocks for just 1 year, you could lose 30% of your money, or make up to um, or make a 30% return in 1 year. That has happened. After a 5 year period, you really greatly cut the potential losses in the stock market, and mostly are likely going to have gains. And if you hold it for a 10-year period, um, there's going to be almost no chance of losing money and a good chance of making money. So you could see that, and the average return here for this 50-year period is 10%, 10.7%. For bonds, you'll see that they're less risky. There's less money you could lose, and you could still lose money in a 1 year period. But as time goes by, there's less of a chance of losing any money, but the overall return is less overall than stocks. And then finally, treasury bills, there's almost no chance of losing money, but very little average return. So this would be less risky, less return, more risky, more return. However, if you wait 10 years, the risks don't change that much in a 10-year period, and stocks always outpace inflation in a 10-year period and generally develop a decent return. So that's why when you're starting out, your asset allocation as a younger person, you should have most of your money in stocks. And then as you grow older and you have shorter time horizons to when you want to access that money, you should start changing the asset allocation into more bonds or real estate or some other investments that are less volatile, like treasuries. Um, so the asset allocation is really what percentage do you want to put in stocks, what percentage do you want to put in bonds, and what percentage you want to put in other investments. So diversification are, putting your money into different classes of these investments. Now, common stocks, you definitely want to have a long time horizon to invest in common stocks, but the important thing is to really understand that this allocation changes over time as you come closer to retirement. Um, Now, of course, here are some basic facts on this. This is this slide is a little tight here, but this will be backed up in the, if you have a hard time reading this or seeing this in the presentation, this will be in the PowerPoint slides in the class. Also, this is something that's in the textbook as well. So factors impacting your asset allocation, of course, there's going to be um, time horizon. How long before you need this money? The longer your time horizon, the more you can put your money mostly in stocks. Your capacity for um, risk, you know, if how much risk are you comfortable with? The more risk you're comfortable with, um, the more riskier assets you can assume, and hopefully the more tolerance you get. So you have to really look at your situation. Are you looking to retire? How is the money being invested? And this gives you a better idea of what your risk tolerance is. So if you have a high capacity for risk and you have a high risk tolerance, then you can um, take on some of those bigger risk companies. Just imagine the people who took the risk on investing in Amazon early, Google early, um, Netflix early. They would have had a lot of risk and ups and downs in the initial first 10 years, even a company like Tesla, but then later on done much better and been very well rewarded for their risks. So here is different asset allocations and the returns for portfolios over this 50-year period. So if you look here, 80% stocks, 20% bonds, you would have had an average return of 10.6%. If you look at If you had a more balanced portfolio of 40% bonds, 60% stocks, you would have had only a 9.7% return. If so, years with a loss would be 11 out of 50 years here. Here would only be 8 out of 50 years with a year where you had an overall loss. Now, if you did 60% bonds, 40% stocks, your return goes down to 8.8%, and you still have 8 out of 50 years of a loss. And if you have bonds at 80%, stocks at 20%, your return goes down to 8%. So you can see that different asset allocations result in a different return over time. Now, how does the market know what's price the stock should be, or how are stocks priced in the marketplace? Well, this we'll call we think of the market should be in normal times. The market should be efficient. So outside of times of extreme bubbles or times of extreme panic, majority of the time the market should be efficient, meaning that the stock price should be close to what the value of the company should be. So hopefully the more efficient the market is, the faster um, investors will react to new information, more accurately they'll react, and the more efficient or truly efficient a market is, the less benefits you get from actual stock picking or stock analysis. Trying to find companies that are undervalued or trying to sell companies that are overvalued. There's less of that would be effective. But since the market is not perfectly efficient, there is room to discover stocks that are going to go up a lot in the future or stocks that are going to have less of a return in the future and sort of trade based on that information. But by and large, how it works is investors um, give information about stock price through their trade. So it's strictly supply and demand. If people keep buying a stock and not enough people are selling that stock, they're going to have to raise the price to a point where the people who own the stock think it's a good to sell. So that's how the stock price works. So it's a balance between buyers and sellers. And when there's an imbalance, too many buyers, not enough sellers, the price goes up. If there's too many sellers, not enough buyers, the price goes down. So it's the basic mechanics of how a stock market works. So we call these the security markets. So there are different security markets. There are stock markets and bond markets, and companies go to these security markets to raise money. So you get a company like Chipotle Mexican Grill or Shake Shack. They'll do an IPO, which is initial public offering, to sell part of their company to the public. Then they take the money that they get that is raised by selling stock and they start opening up new locations, reinvesting those funds in the company and growing those funds. Um, so the security market is a place where in the primary market, companies go to list an IPO and sell their stock for the first time. And then in the secondary market, um, this is where me and you can buy the stock and we'll talk more about these two markets in a second, we can buy these stocks and trade them with each other. Now, the primary market, this is where IPOs happen. This is also where if new shares are going to be sold from a company, it would happen in the primary market. And the primary market is going to be involved with an investment banker, underwriters, and the prospectus. So think of the primary market like this. If you ever bought a new video game you went to Best Buy and you buy a new video game, now you play it for a while, that would be considered the primary market. But if you play this video game for a while and you want to resell it, go to GameStop and sell it back to them used, GameStop would sort of be the secondary market where you could sell it used and you can also then buy another game used and pay less of a price for it. So the company that sold that video game, they're only going to make money when you buy it from Best Buy. If you buy a used game from GameStop, if you sell your video game to GameStop, the video game manufacturer is not going to make that money. You are when you sell the game. And if somebody else buys your used game, um, the video maker is not going to get any money for that. Just like a textbook too. If you bought a new textbook, the textbook company gets money for that. If you buy a used book, the bookstore will get some money profit, but the textbook company doesn't. And that's why college textbooks are typically very expensive to buy as a physical book. Now, investment bankers, underwriters, and prospectus, these are how a company does an IPO. So if you want to become a public company, you go to an investment bank. You hire them sort of as a expert, and they will do all the paperwork and everything necessary to bring your company public, and they'll work with underwriters to make sure that your stock gets sold in the IPO market. And there are people who will support the sale of your stock, and the prospectus is just a document stating what your company is all about and their financials. Now, in the secondary market, these are where you and me as regular stock buyers and sellers would buy and sell stock. So 99% of the time as a small investor, you can't buy an IPO because those are locked up by the big brokerage companies and mutual funds and big investors. So we never really have access to buy an IPO before it hits the market. Once it hits the secondary market, that first day of trading, we can buy and trade that new stock, but at a significantly more expensive price. Now, secondary markets, two of the big ones are the New York Stock Exchange and the NASDAQ, or over-the-counter market. So an organized physical exchange like the New York Stock Exchange, which you could go visit in New York City, Manhattan's on Wall Street. This is where you might have even seen it on TV once in a while. They usually have it on the news. This is where there are a physical location where they have traders trading stock. But there's also an electronic over-the-counter market, which think of there's no physical location, but everything is all the stock trading is through a computer or through a phone. So it's sort of like the New York Stock Exchange is sort of going into the office to work, and the over-the-counter market is sort of working from home, where people are trading stocks on computers remotely. There's no physical exchange. So you have a bid price and an ask price. So this is important. If you buy, there are these two prices, bid and ask. The ask price is what you pay for a stock. The bid price is what you would sell a stock for. Now, so the bid price is the highest price someone's willing to pay you for a stock. And the ask price is the lowest price at which someone's willing to sell you a stock. So for example, if you look at a share of stock, the bid and the ask might be $5, the bid might be $4.75. That means if you buy the stock, you have to pay $5. And then if you turn around the next second and sell it, you're only going to get the bid price of $4.75. So the difference between the ask and the bid is what we call the spread. And that 25-cent spread, the difference between the $5 and the $4.75, is the profit that traders and brokerages will make when they facilitate a market for you to buy and sell stock in. Now, there are many stock markets around the world, not just the US. Canada has a stock market, Mexico has a stock market, Europe has multiple stock markets, and shares are traded all over the world. Now, some foreign shares can be traded on the United States stock exchanges. So there is a process, and one of the processes is American Depository Receipts, an ADR, where international stocks can be cleared to be traded through American exchanges. So companies like Sony, which is a Japanese company, and Toyota and Honda, which are also Japanese companies, you can buy these companies on the New York Stock Exchange. So in the New York Stock Exchange, also the NASDAQ, it's not just US companies, even though these are US, United States exchanges, there are also companies on these exchanges from many foreign countries as well that open up the big international companies to be sold to through American exchanges. And they do this because it creates more liquidity or more of a bigger market for them to sell their stocks. Now, the stock market was prone, and can be prone to a lot of fraud and unfair trading practices. So the securities markets are regulated by the Securities and Exchange Commission. And this is a federal regulation agency that comes in, and their main goal is to protect investors from being lied to, getting being information being falsified, or companies doing tricky things to steal your money. So this regulation is used to help curb inside trading, market abuses, misrepresentation by financial advisors or mutual fund companies. So there's been a lot of, throughout the years, there's been a lot of scandals and scams on the stock market. I mean, you probably remember Bernie Madoff and his pyramid scheme. So there's these things go on, these abuses, and the SEC is there to try to um, prevent this and prosecute people who do insider trading, which is just basically trading stock on information that wasn't public. That you're not, if you're an insider of a company, management or owner of a company, you have to, you know, um, make publicly known when you buy and sell a stock before you buy and sell a stock, so it's so people know, okay, he has scheduled to buy 1 million shares within the next month, and then they can buy those shares. If they have a piece of information that is not yet public about something the company is going to do, and um, an employee of the company, gets this information and trades the stock based on this information, then that's insider trading, and it's illegal. Now, when you place an order, you can place an. This is how do you buy a stock? So, say you're going to buy a stock and you want to place an order, you want to see how a stock is traded. So first thing you have to do is decide how many shares of stock do you want to buy. Do you want to buy 50 shares of stock, or 75 shares of stock, 10 shares of stock, or 100 shares of stock? We could break these up into round lots and odd lots. Round lots are anything that's a multiple of 100. 100, 200, 500, 600, 1,000, 2,000 shares are all round lots. Odd lots are 50 shares, 75 shares, 10 shares. So that just depends on how you place the order. All professional traders usually buy in round lots. It's a small investor that trades in odd lots. Now, the time period for which the order will remain outstanding. You can have a day order, which the order is just good for the day. You can have open orders, or sometimes called good to cancel orders, which are open for multiple days. You can have a fill or kill order, which means it's just open for one chance. Um, and these are just different ways you can place an order. So basically, say the stock is at $50 a share and you want to put an order in to buy it at $45 a share. You could place that order, um, and you could say, I have a limit. I only want to pay $45 for that share. And if it's good to cancel, that order will stay open until the stock actually reaches, if it does reach $45 before it buys it. So you do have um, some ability to control when and how much you pay for the stocks. Now, a market order is basically, so we're getting to the next. A market order is basically just stating your intent to buy something. So it's like walking into a store and saying, I want to buy chocolate milk. So a market order is basically you walk in the store and you say, I want to buy chocolate milk. They hand you chocolate milk and you pay for it. And whatever the price the milk is, you pay for it. That's a market order. You just go and buy it. Now, a limit order is something where you say, okay, I want to buy this chocolate milk, but I want to only pay $2 or less. So if you go in and you ask for that chocolate milk and it's currently only available at $3, the order's not going to fill. It's a limit order. So the trade will only be made at a certain price or better. Now, if you do a limit order at a good to cancel, that order will be there to buy the chocolate milk at $2 a bottle, and maybe for the first 2 weeks nothing happens, but then the milk goes on sale for $2 a bottle, and eventually your limit order turns into a purchase at $2, the price you wanted to pay for it. So basically this almost like a timed order you could put. Now a stop or stop loss order is a way of selling a stock at a specific price level. So say for example, you buy a share at Amazon at $20 a share, and then Amazon goes to $1,000 a share. So you say, well, I've made a lot of money on this. I want to protect myself. So I'm going to put a stop loss order at $950 a share. So if Amazon goes from 1,000 to 1,500 to 2,000, I'm still going to own it. But if Amazon dips down to $950, I'm automatically going to sell it with the stop loss to prevent any further losses. So it's a way of protecting a bottom line in what, a minimum uh, price that you don't want to own the stock. If it goes below this, you want to sell it right away because you feel like it's going to go much lower than that. And that way it can protect you from any type of market crash. There's also something called short selling, which is a lot more um, common these days, and I think a lot more people know about this after the whole GameStop and meme stocks that occurred a while ago, where people saw stocks in big short positions and decided to squeeze the shorts, what they called. A maneuver where there's a large short position and people start buying the stock for forcing shorts to cover. So, what is short selling? It's basically selling something first before you buy it. And it's a way to make money when the price drops. Um, so the more the price goes down, the more money you make. So basically, what you're saying is, I'm going to sell. So say Netflix was at $7 a share, $700 a share, and you say, you know what, I think Netflix is overvalued. I'm going to sell it short at $700 a share. Now, you sold it before you bought it, which means at some point you're going to have to buy it to close out the order. It's sort of like, you know, say you're in a store and they don't have any PlayStations in, but you can put in. They're going to still sell you a PlayStation. And they'll just deliver to you when they actually get stock back in. So that's the way of selling something first before you actually um, a store can sell you something before they actually buy it and give it to you. So it can happen. It's just not something we're used to because we're used to always buying stuff first and maybe selling it. So we're in this process of our whole life of buying something and selling it. We're not used to the reverse, which a short sell is a reverse. You sell first and then you buy later. So if I sell stock, I sell Netflix at $700 a share, the stock goes down to $200 a share, I buy it back, my transaction is settled, and I make $500 a share. So how does this happen? Well, you borrow stock from the broker and they'll sell you. You're borrowing stock from the broker to sell. So they lend you stock that you have to sell, and at a certain point you have to return it. So that's when you buy it, you're returning it. And usually a margin account is required. So you have to, basically a margin account means you have to have some cash capital in your brokerage account to fund this short position until it's satisfied, until it's settled. It's sort of a collateral. So you want to sell high and buy back lower at a lower price. But if the price increases, you may have to buy back at a higher price and then you'll lose money. So it's just think of it as the opposite of buying a stock and selling a stock. So short selling is instead of a long position or a typical position is you buy a stock and then you sell it. A short position is you sell a stock first, then you buy it back later. Now, if you're looking at profits from a short sell, basically this is the profits from purchasing a stock and selling it later. This is how you'd figure out the profits. On a short position, basically you kind of flip the equation around and you take the initial price minus ending price plus dividends. Well, here, so you kind of move that over here. And of course, you have to subtract commissions. And that's how you develop your profit, because it's just the inverse of how you would calculate it. Now, let's switch over to dealing with brokers. So the most common way to purchase stock is through a stockbroker. So this is a licensed person who's able to buy and sell stocks for you. So basically, there's really not too many choices for you to buy a stock other than utilizing a broker. There is one workaround where you can buy it directly from a company through a dividend reinvestment plan, but that's very uncommon. Typically, for most of us, if we want to buy a share of stock, we have to go through a broker. And we can use either a full service broker or a discount broker or online broker. So for most of us, we're not going to use a full service broker because their commissions are very expensive, and typically you need to be a multimillionaire to really take advantage of a full service broker completely. Most of us will use a discount or online brokers. Like you have the Charles Schwab and Fidelity, which are very well established discount brokers, but you might have E-Trade as well in the mix. And when you open a brokerage account, it's like opening a bank account. So you basically open an account similar to a bank account. You put money in the account, and then you can get financial services out of this brokerage account. So basically, brokerage accounts, may seem a lot like a bank account or a bank because you can get a checking account, a credit card, a money market mutual fund. You can you can make automatic payments out of this account. So for all intents and purposes, a brokerage account's a lot like a bank account with what you can do with it, with one big difference. The big difference is that your brokerage account can do something your bank account can't. You can buy and sell stocks out of your brokerage account. You can buy and sell bonds out of your brokerage account. Um, so if you want to have a portfolio, the first step is to open up a brokerage account where it gives you access to buying and selling stocks, bonds, and mutual funds, which is something you can't buy from a bank account. Now, when you have an account, probably you're going to start out with a cash account, which means you're going to fund all your purchases with cash you deposit in the account. Later on, you can open up a margin account. This is an account where you can borrow money. So you can borrow money from the broker, and they'll have things called initial margin. So it's usually set at 50%. So if you buy a stock, you have to put up half the money. So if you buy $10,000 of a stock, you will have to put up $5,000 of your cash, and you can borrow $5,000 from the bank on margin. The margin maintenance is if the stock price goes down, they may ask you to depending how far the stock price goes down, there could be, if you hit the maintenance percentage, there'll be a margin call and you'll have to put more cash into your account to shore up the account so that it's never unbalanced, that you're never in a negative position. Um, and of course, just like a bank account, you can have a joint account with a spouse. Um, so a lot of different types of accounts you can have with a bank, like a joint account. You can have the same type of account with a brokerage account. So a big question is, how do you choose a broker? And you have the full service broker, which can provide a lot of personal service and advice, but at a much higher price. Or you can use a discount broker where the transaction costs are low. Oftentimes, trading stocks could be zero commission, and there's some free research or some support, but you're basically not getting you're not getting a personalized stockbroker to give you advice on what to buy and sell. So in a full service account, you may have an account manager or a stockbroker who will advise you on stocks to buy and sell to try to make money with it. With a discount broker, basically you're in charge of all your transactions. And for the majority of people, they go with a discount broker because if you need someone to buy and sell stocks for you, you can just buy a mutual fund, and that comes with a mutual fund manager that trades all the stocks professionally. Now, in times of bubbles or speculative periods like we had in 1995 to 2000 and like we had in 2016 to 2020, 2021, we have these speculative periods where the market's going up, there's a bubble, and people, no matter where you throw your money in the stock market, you're going to easily make money. So this encourages a lot of people to do day trading, and they generally are going to buy and trade stocks they may hear about on the internet or from a bulletin board or from Reddit, and they're going to make these short-term trades. Let me buy GameStop at $50, sell it at 70. Let me buy this trendy stock and then sell it in a couple of days or the same day, and you're making money. So in the short term, you think that this is so easy. I'm a day trader. I can quit my job. Look all this money I'm making. But you have to be prepared. There could be one day where the stock market goes down 10%, or the positions you have go down 20, 30%, and you lose all the money you worked all year to make in one day. So day trading is not investing. It's gambling. It's speculative. People often will tell you about all their successes when they're doing day trading, but they're never going to tell you about the real losses. And most people, day trading works in these waves where a bunch of people come in, they do all this day trading, the market crashes, they lose all their money, they go away, they never invest in stocks again. The market recovers, goes into a really good period. A whole new group of people come in to do day trading and run around telling how much money they're making, how great things are until that crash comes. So it may, these people may try to get you to believe that it's easy profits and you're going to make money and it's a sure thing and they have hot tips and expert advice. But in my 30 years of trading, I've never seen it work out for anybody who did speculative day trading. I've never seen one day trader long term ever make a decent career or money out of it. The only people I've seen become millionaires and make a lot of money in the stock market are the long term boring traders that don't day trade. They buy a stock and they hold it for 10, 20 years. They don't buy and sell short term. They just keep accumulating dollar cost averaging in a boring asset allocation portfolio, and they don't spend more than 20 minutes a month working on their investments, and they do very well. So if investments become almost a part-time job with the amount of effort you're putting in trading and watching the market and learning about stocks and talking to people, you're just, an enthusiast as a hobby, as a day trader, and you're going to get burnt. So the online trading has really facilitated the ability to do all this day trading quickly, but I don't recommend it, and it is very speculative and it is highly risky. And like I said, I've never met anybody who was a day trader that over the long term, over a 5 or 10 year period, has ever made significant money. Sure, there are days or months where they've made a lot of money and they think this is their career and they're going to quit their job. And you get that one period of 6 months where the stock market goes down 30%, you lose everything. And then where are you? So you have to trade for the long term. Don't get seduced by the dark side of the day trader. Okay, sources of investment information. So if you want more investment information about stocks and the market, you basically, many places you could go. So companies all release annual reports and quarterly reports that you could read and even listen to their corporate calls when they do. Usually companies will have a recorded audio of their meeting with investors. You can get brokerage firms produce investment reports that analyze stocks. There's a lot of in the press. There's a lot of magazines and newspapers that talk about stocks, and there's a lot of TV stations and news programs that talk about stocks. There's investment advisory services, plenty of internet websites and locations to learn about stocks and get news on stocks. There are, pretty decent sites like Yahoo Finance, which gives you a lot of current up-to-date news on stocks, lets you house a portfolio and put groups of stocks together and, do some research and do a deep dive into these stocks and go down the rabbit hole and learn more about all this stuff. So there's a lot of sources of information. There's more information you can probably get to in any one day on stocks. So Yahoo Finance is a great starting out position. CNN Money is a good location too. The Motley Fool is a good for beginning investors who want to learn more about investing. And there's also a governmental site, Edgar, that does a lot of financial postings from companies. So there's a lot of good material there. Now, as a summary, we have a long summary here. Investing is something everybody should do, but you need to be smart about it. You have to think about your goals and know when it's the best point in your life to start investing. And you have to break away from the seductive lure of speculative or gambling investing. This is stuff that a lot of college kids start out using Robinhood and trading on these, small Acorn, these small little websites or apps, and buying and selling hot stocks with, they have $1,000 to play around with, and they make some money, and they think they're the smartest trader in the world. But it's a lot more in this. You're taking a lot of risks through the speculative trading. So you really have to, at some point, when you're done losing money on your trades and you want to take it seriously, you become a long-term trader. And then you just follow some very common advice. You really only need to own a handful of stocks or a couple of mutual funds and keep reinvesting in them long term, and you're always going to come out ahead. So you have the sure thing as a long-term investing. If the smart asset allocation is a sure bet of making a lot of money in the long term. Speculative short-term day trading is a sure bet to lose a lot of money in the short and long term. So Some people need to learn that lesson for themselves. They don't want to take my advice on it, or they want to argue with how great they are. And fine, learn the hard way if that's what you choose, because there are a lot of risks in making an investment. You have to, and time will help mitigate these risks. But in any particular day, you're facing interest rate risk, inflation risk, business risk, financial risk, liquidity risk, market risk, political risk, exchange rate risk, call risk. There's so many risks that only time can really, and a proper asset allocation can really mitigate. So the longer your time horizon, the more risks you can take on. So if you're going to retire in 30 or 40 years, you can put all your money in stocks for the first 20 years before you retire. You can afford to take some big risks. Um, you know, but as long as you have the right asset allocation, you hold these stocks for a long period of time, those risks may really only be temporary. So asset allocation and long-term investing can help mitigate majority of the risks of investing in stocks and bonds. Don't try and time the market. Don't You just want to have all your money in the market all the time, and just continue to add dollar cost average, add to that pile of money continuously. Because like history has shown, in a 10-year period, there could be 2 years where stocks go down and 8 years where they go up. So even if your money is invested in the 2 years the stock market goes down, um, you're going to make a lot of money in the 8 years it's up. So if you take your money out but don't put it in, and you miss 2 or 3 good years, you're missing a lot of growth potential for your investments. Um, they say that if you miss 5 of the best trading days of the year, you might miss half the return you potentially could have made that year. And that's why you want to stay continuously invested. Um, we have we talked about the primary markets where stocks are first born, and when a stock is traded in the primary market, the company gets the money from selling those shares. Once the money graduates into secondary market and is traded among traders, the company doesn't get any money every time the stock is traded. They don't get money again. They only get it the first time it's sold, just like when a video game is sold new, the video game company gets the money, but when it's sold used, the video game company doesn't get any money or profit from that used trade. Um, Remember that you have some control over how you buy and sell stocks. So using market limit and stop loss orders, and you can always talk to your broker about these types of orders with a little bit more detail to learn about them. But they give you a little bit more control over how and when and what price you pay for a stock. Now, this last piece of information in the summary is do your research. This is a twofold type of advice. One, don't listen to other people's um, stock advice on individual shares of stock. A lot of people they may have bought a stock and they feel good about it, so they're going to run around telling people you have to buy the stock, it's the greatest stock. And you don't know what research they did, you don't know what track history this person has. I mean, I would really caution you before taking advice from anybody to buy or sell a stock. You should do your own research and say, is what they're saying true? There's plenty of sites to do your own research. Get to know the company, the products, the management, the trading history, um, the results of the company. So do your own research before you buy or sell an individual stock. Don't just listen to somebody's personal advice because they can easily be wrong. Um, okay, so that's a chapter on the investment basics. Next chapter, we're going to do a deep dive into investing in stocks. See you then.